Today's show is brought to you by Direction. We're talking about their breakfast commodity strategy ETF. Ticker is BRKY. This gives you exposure to everything that you put on your breakfast table. Commodities have been the theme of the year so far in 2022, and this is a way to get exposure to that theme.
Episode 51, Canadian edition of The Compound and Friends. My friend Eric Jackson is here. Eric, say hi to everybody.
How's it going?
See the high energy that I come into the show with? We need you to mimic that. We need you. No, I'm just kidding. All right. I'm so happy that you're here. It's actually a perfect week for you to be here. Perfect period of time for you to be here because the most volatile, wild parts of the market are the parts that you know best.
Right.
I think, right? Okay. For better or for worse, yeah, right? Okay.
Exactly.
Absolutely. So thank you so much for coming. Are you staying in New York all week?
No.
Okay. Just blazed in?
Just for the day.
Oh, that's awesome.
Just for the day.
All right. Get anything else done today?
A little bit.
Okay.
But not much.
Not much. All right.
You had some rain here this morning. So.
No doubt about it. All right. Well, I came to you. I froze my ass off, so we're even. All right. And Michael Batnick is here as usual. Michael, how are things?
Not good. Not good, Bob.
Okay. Fair enough. We'll hear more in a moment. Duncan's in the house. John's here. Nicole's here. You guys feeling good?
Yeah.
Yeah? Duncan's got the backwards hat thing again. Is that because you're looking into the lens of the camera? Or is that
looking into the viewfinder, yeah.
Or is that an affectation?
It's the viewfinder.
It's the
mainly.
viewfinder?
Yeah.
All right. We'll roll with that. All right. First things first, we wrote a really nice introduction for you. So I'm going to deliver that. And you could just correct me or react to it. Okay? All right. Eric Jackson, PhD, which we'll get to in a minute, is the president and portfolio manager of EMG Capital Limited. And you started that in 2017. So 5 years?
That's right.
Okay. EMJ is a Toronto-based hedge fund focused on fundamental long-short analysis on companies where technologies, products, and or business models are undergoing change and innovation. Let's stop right there. You've been at this a long time, and you've been following innovative technology companies way before 2017. Mm-hmm. What was your entree to the space, and what made you fall in love with it to the point where I guess you're doing this, 20 years or so?
Well, 20 years ago, I was doing a PhD at Columbia.
Right.
And everybody I didn't know it when I applied to this program, but you're supposed to go on and be an academic at a business school. Yeah, I could tell within a year or two that wasn't for me.
Okay.
But that was in the middle of the dot-com era.
Yes.
And that was crazy times up at Columbia. Because usually the people who go to Columbia Business School, they either wanted to be bankers or work at McKinsey. And that was the only, it probably rivals 2020 or first half of 21, where people just sort of lost their minds and they were like, "We're gonna be rich."
Yeah.
And I remember Fred Wilson would come up there and
change the
he's
world.
Like, "We're changing the world," and the audience, the students would jump up and man, that's what that's what we're gonna do.
Right.
And so it was nuts. So I drank the Kool-Aid at the time, and so. My father-in-law said, "Hey, I got a friend back in Toronto who's starting a software company. They're doing this voice recognition stuff." And
learn out in Houseby?
It was sort of like a company, in that space, but they were doing the software. So they were kind of doing like Siri or Alexa before. Yeah. 20 years before it really hit the main, the big time. But back then everyone was saying, "Oh, this is going to be the next big thing. You're just going to talk to your phone." We didn't have smartphones back then, so people were texting on their flip phones and stuff. So if you could just talk to your phone was supposed to change the world. And luckily, I was lucky because it turned out to be a real company with real technology, so it stayed in business. And the first real venture capitalist that put money into us back then, the company was called Voice Genie, was actually their headquarters are just across Bryant Park from us right now. It's this firm called Insight Venture Partners. Okay. And now they've raised 11 funds or 14 funds and multi-billion dollars each fund and all this. But back then there were just two guys from Goldman Sachs, young guys. The main partner is this guy named Jeff Horing. And he had this vision for investing in technology. And so just working there, meeting Jeff, meeting other people in the industry that I was, I didn't meet many Belgians who were with Learn Out in Houseby at the time.
Okay.
But there was
there
was Tell Me was the big,
I remember Nuance.
Nuance, yeah.
Learn Out and
Speechworks was a company up in Boston that was doing the same thing as Nuance. This company Tell Me was the belle of the ball in Silicon Valley. They'd raised all this money, and anyway. amazing people like at all these companies, and so many of which I've stayed in touch with to this day, and they've gone on to like amazing things. But that got me, bitten by technology, but I'll never forget going through those. Obviously the .com bubble crashed, right?
Yeah.
And I signed my employment agreement in March of 2000. I remember going home and listening to the AM radio that NASDAQ.
You might have actually caused it.
Now
that you're telling me
stuff.
this. Right.
But the wild thing is that everyone now is like, oh man, this is the worst market ever. When's it going to bounce back and all this? I'll never forget from that period. It was like it wasn't just like the end of 2020 came. And everyone's like, well, 2021, things got to turn around. It's been like 9 months of this stuff.
Yeah.
And then like it goes all year, and then 9/11. And then you get to 2020 or 2002. Oh, this has got to turn around. And it just went on and on. Things didn't really turn around until second half of 2003.
Yeah.
And it was just like you're sort of like Night of the Living Dead, just walking through this. All the people who'd been attracted to the industry had left and stuff. So anyway, that's a long way of saying
they went back to law school. They went back to banking.
Back to banking, back to consulting.
The thing
B2B,
that I remember about 2000 to 2002 that really reminds me so much of this period is not just NASDAQ stocks crashing 90%, blah, blah, blah. But to your point, like, you have the .com bust, and people forget it was not just .com. It was also on a parallel track. It was wireless, and it was just telecom in general.
Yeah, WorldCom.
So then you had WorldCom, and then Enron.
Enron.
Right.
Don't
and
forget.
then 9/11 is like the 1,000-pound fat lady dropping on the stage.
Right.
And you almost can't believe it. And then the malaise. Goes on a while longer.
So let's talk about the malaise, because I was saying that people are really bearish right now, where you can see max pessimism before the market bottoms, because eventually there'll be this malaise and this apathy where people are like, yep, stocks are red again. And they sort of hit the acceptance phase of that cycle. I don't think we're there yet.
Yeah, I mean, that's the $1 million question.
Call the bottom anyway.
But
go ahead.
I'm just talking about like its sentiment. Forget about the bottom or whatever.
But yeah, it can't really get worse. Is what I feel. I start like I'll never forget the May the 12th.
Duncan, I think we have our episode title.
May 12th was a day. I don't know if you guys remember, where the market opened like way down. I can't even remember what set it off overnight in the futures, but like. Everything was down, huge down. That was the low for Cathie Wood's ARC Innovation.
Until today.
She still hasn't. She's still above it, if you can believe it, from a month ago.
Okay.
And so it just, and then that was the day that I think Coinbase, opened at 40 and closed at 80 or something like that. It was just a crazy day.
Simpler times, Eric.
But when I started seeing those prices, like I thought, okay, well, this is it. Now we're here. And then of course,
so like Robinhood bounced from 10 to 15. Now it's 7.
Right. I know.
Because there's always a door in the floor. Right. And that's the thing that. What do you got,
John? Throw this chart up. I mean, all right. Here's what we're looking at. We're looking at Square, DocuSign, Zillow, Coinbase, Robinhood, Teladoc, Peloton. These are the declines. Again, Square down 80, DocuSign down 82, Zillow down 86, Coinbase down 86, Robinhood down 90, Teladoc down 90, Peloton down 94. Holy
These prices
shit.
for the companies that were public prior to the pandemic, these prices are now all not just below pre-pandemic, but significantly, as though all of the new customers and stuff they sold over the last 2 years just doesn't matter.
We might crash through their last private round of financing. What did Robinhood raise at in 2020 when they had the public shitstorm? They raised money. I don't know what valuation was, but they're $6 billion right now. It can't be that much lower.
Right.
Yeah, I think they have more cash than market cap is what I read.
I know.
They're worth more dead than alive.
I tweeted that out yesterday, and this my old friend who's a great investor said, yeah, that's true, but it doesn't mean they're a buy.
It's not it's not unencumbered cash.
Money.
Right.
Yeah, exactly.
It's cash that's spoken for.
Right.
Yeah, it's very, very big difference. So I wanted to start with this. Now what's going to happen next is you're going to start hearing people say growth investing is dead, if they're not already saying it. And this is now my third or fourth go round, yours too, in this kind of cycle.
Right.
But you're going to start hearing people say there's no reason to ever give these companies money based on their prospects 5 years from now. Like, why would anyone ever do that again? Why would anybody ever look at anything other than cash flow? total addressable market as a metric for valuing stocks is a joke.
Price to sales is dead.
Right. So that we'll go through that, and maybe that lasts a year or 6 years or whatever, however long that has to happen. But that's like that train's never late. That's right on time. Mm-hmm. So I think I don't know. Are you hearing people start to talk that way or not quite yet?
Oh, for sure. I mean, you turn on CNBC now, and everybody wants to talk about energy stocks.
Yeah,
and,
I wonder why.
When was the last time? Maybe 10 years ago that people were talking about energy stocks.
Yeah, Schlumberger is super exciting.
Yeah. So, growth is out. Energy's in. Everybody wants to kind of recency bias. Just keep. Plow into whatever has worked for the last.
But a lot of that is a lot of that is survival.
Yeah.
If you work in the markets. To some extent, I know you're supposed to not do this, but let's talk about people as they really are, not how we wish them to be. To some extent, part of your job is not just beating the market, but staying employed.
Right.
And you have to go where the money is being made. Like everybody, to some extent, people that have been around for 30 years maybe don't have to. People who have been around for 3 years, they have to talk about what's working. Because otherwise you don't keep your job.
Well, people are fiduciaries to their shareholders and their families.
Right.
Yeah.
Right.
Exactly. So you have to expect. Yeah, I feel like you have to expect some of that rubbernecking. Like, oh well, what is going up? Can we sell that? Right. So okay. So I think there's gonna be some element of that. How long do you think the pessimism has to run its course before people are willing to look at innovation again as something that they get excited by as opposed to being afraid of?
Well, this pullback is unlike any other that I can remember in tech, specifically since .com. But the malaise isn't as deep as it was back then, because I think you still have people that are saying, well, it'll come back.
It's only been 6 months of
That's
this.
what I'm saying. We just started.
Right.
Just started.
Right. But compared to every other pullback, like you remember the Q4 2018 pullback when people were like slitting their wrists and begging Jay Powell to get more.
That was kind of bad. That was 40. But this is like 90.
That was also market wide. This seems,
right.
This is market wide now, true, but this seems very specific to tech.
And you only see charts like that in the market amongst like not just tech, because it's not the FANGs that are doing that. It's
super discretionary.
It's the smaller growth. It's biotech. It's smaller growth. Whatever, profitless tech. People like to call it now.
To that point, Microsoft, Apple, and Google are each down 30. Mm-hmm. Amazon's down 45, but I don't know if you would bucket it necessarily with those names. But Netflix is down like 75.
Yeah. Netflix has fallen out of the acronym over the course of the last year.
And now
they're no longer
Tesla's finally taken it on the chin. That had held up relatively well. That was fast. Now it's down 50.
Yeah, I think I saw on a chart yesterday they're still positive for the year. Maybe not after today, but
But then if you look at GM has gone from 70 to 29. So it's not like you did yourself any favor being like, well, I'm a value investor, so I'm in GM and Ford. You're as beaten up for doing that,
dude. They're
as
down.
Tesla.
They're down. GM's down 53.
Right. And so when will they come back? I think they always come back to growth because
the investors.
Yeah, because at the more than any other sector, I think, and this is the reason why I'm attracted to it and why I invest in it, is that these are the best returns over time of any other corner of the market.
And this is what you have to live through.
And you have to live through it.
Yeah.
Did you know Apple had 3 separate 80% plus drawdowns over the course of its life?
Really?
Apple, and obviously that's going way back.
Jobs left.
Yeah,
that period.
That's going back to when Jobs went on his walk in the desert and all that.
But probably 08.
Don't
Apple
you think that
killed.
a lot of these names just won't come back to where their 21 high was?
No, that's true. I think both are true. So Netflix had major drawdowns. Salesforce had major drawdowns. Amazon has
all the winners get killed.
All these winners have gotten killed.
Yeah.
But then they come back, and then everyone can point to them and say, "Hey, but if we had just picked these ones." But you're right. There are hundreds of others that we've never heard of it from again.
But from this point,
Pets.com,
new money can make a ton of money, even if they don't take out the 21 highs, right? There's maybe opportunities.
They almost don't need to anymore to have big returns.
I think right now, Cathie Wood's ARK investments from the peak is down 77%. 77%. Okay, that's a year and a half.
Let's throw this up while Eric's talking.
And most of the smaller stocks, like the ones you put up before, are in the same boat. But how does that compare? Well, the total drawdown for NASDAQ during .com was, I believe, 74%. The Nikkei, when that bubble burst in Japan in '89, it took 20 years, but that was like a 79% drawdown.
Yeah.
And so, one thing I'd say is, or makes me bullish about the sector, is that ARK is not an index like NASDAQ was, but obviously it's a group of companies like that we're talking about here. And anytime you see a grouping like that drop 77%,
you gotta start shopping.
Counterpoint.
You're not going to press your shorts.
So I agree with that conceptually. The reason why I think that may not work in the case. So we have a chart up. This is 3 years of ARK Innovation ETF, the flagship. There was a point in February of 21, where it was up 240% from the summer of 19. It is now negative 13 in the 3-year period versus the overall S&P, which is up 36. So now anybody that was building this product into their asset allocation, that's the fucking back test now. That 36-month period of minus 14 versus plus 36 on the S&P. And we know that financial intermediaries, consultants to pensions, whatever, nobody wants to put something like that into a back test that blows up the historic returns because you're not going to win the business. You're not going to bring on the wealth management client. You're certainly not going to improve, right? So that's what makes it so tough for something like that to come back. Because who's coming in now?
Right.
It makes sense like who would have come in January of 21. Anybody would come in. It was going up every day. So that's one issue. And then the second, of course, so that takes time to heal. The second issue is not the same portfolio. She's active. Mm-hmm. So it's not like an index where it's static components. Mm-hmm. So even FANGs have a better case to be made, right? Because it's the same FANGs we're talking about. I don't think that her top 10 looks much like her top 10 from the peak. So that's what makes an actively managed ETF more difficult to say anything down 70-something%, you have to take a look. Maybe in this case not, just because it's a different mix of stock. What do you think about that?
Well, and also at this point, she is a slave to, and not she, all of these companies are slaves to their shareholder base, who is a slave to inflation. That's the only thing that matters right now. And as long as people are seeing these headline numbers, even if it comes down to 7, people have no appetite for long duration assets, which can be an opportunity for people like you who are able to go in and see the business and say, you know what, this is overdone. I don't think most people can do that, but
yeah, when I went back and looked at some companies that made it through the .com and made it through the great financial crisis.
And there's a list.
In 08.
There's a list.
What was interesting to me was that several companies, you can't say the class of growth stocks did this, but there were many examples where these growth companies, they had their moments of capitulation well before the NASDAQ or the S&P bottomed, right? So eBay, Microsoft, even back then, 20 years ago, in .com, it was more of a growthy stock. Right. But both of those bottomed in December of 2000, which turned out to be 2 years before the NASDAQ.
So they stopped going down before the overall market.
Amazon bottomed the month after 9/11, which was a year before the rest of the market bottomed. So my point, and you had like in the 2008, Google, Netflix bottomed in October, November of 2008 versus the rest of the market in March. Right. So my point is that I think you want to look for moments of like panic.
This is it.
When on individual names
we're there
that you like,
we're there,
and then look to add to those opportunistically.
Some of the companies that have had the biggest rebounds out of those crashes also used it as an opportunity to slaughter a lot of sacred cows, get out of a lot of underperforming businesses, do it under the guise of, look, we're doing what we have to do to survive, and even making big business model pivots. Obviously, the Microsoft of 2010 was nothing like the Microsoft of 2000. Of course, Office and Outlook were still part of the mix, but they had already been reinventing for a decade by the time that stock started to approach old highs.
I think part of the problem is that some of these names just got so outrageously expensive. For example, Shopify is obviously a great company, but the price to sales ratio ran up to over 60 times.
That's the Amazon of Canada, so be respectful.
No, I am being respectful. So Shopify
is it?
No. The stock price, what?
Well, I think 6 months ago, it was the biggest Canadian
biggest,
company by market cap.
Yeah.
It was surpassed the Royal Bank of Canada.
So one of the
and all
biggest
this kind
e-commerce companies in the world was trading at over 60 times sales. Now it's down to 8 times. So maybe investors are overdoing it on the downside. But this stock is now at the same level it was prior to the pandemic. And I'm guessing that the business is 3, 4, 5 times larger than it was pre-pandemic.
Oh, for sure.
And the stock's at the same price.
Yeah, for sure. Like I full disclosure, I added some yesterday, and because I was just
finally somebody's buying something.
I was looking and saying, this stock went public. First, it went public in Canada. I think it was in 2015. Nobody had heard of it down here. Nobody up in Canada had heard of it.
Yeah.
And it traded only up there for the first couple of years, and before it listed down here. And right now, it's sort of as cheap or cheaper than it was just in the early days when nobody had ever heard of it back in 15 or 16.
I don't know if you remember this. Hold on. You told me, I think it was you, who said the worst thing you could be is the largest market cap in Canada. Is that you?
Might have been me. That's definitely gone around. RIM, Research in Motion, the BlackBerry, Nortel, Valiant. Yeah.
Oof.
Yes.
Like you never want to be the biggest tech stock in Canada.
The kiss of death.
Very bad things happen right
so
afterwards.
So this had a market cap of over $200 billion when it peaked in November. It's now down to 38.
Yeah.
I mean, could it go to 30? Sure, but
sure. Yeah. But yeah, and so that's why I bought some, because and there are other names like that where I say, yeah, I don't know when it's going to bottom. It could be 6 more months, it could be 8 more months, but
what's interesting about Shopify post-pandemic, there's still a lot of business to be done. The comps obviously are harder because the growth numbers from 20 and 21 are crazy. So you had that. But now if you also have a rapidly decelerating consumer appetite to just buy things, like in general, forget about the comps, I feel like they're getting hit from both sides. Because they also if you're in e-commerce, you need like a decent economy. And if the U.S. consumer is about to fold, that's not going to be great no matter how good Shopify is or Amazon or anybody else in the space, right?
Yeah. Yeah, and they also had this thing where the founder CEO, Toby, basically did a Zuckerberg where he recently created a new class of shares to give him total control and all this kind of stuff. Yeah, just a few weeks ago. So you got that hanging over and all the people
Can you do that in Canada the way they let them do that in California?
Oh, yeah.
You can? Okay.
Canada has a proud history of families controlling cable companies up there.
Do you think maybe a way for investors to sift through where the opportunities lie versus what's just not coming back? So, for example, investor attitudes have shifted dramatically. People are no longer subsidizing money-losing companies for you had 10 years to get profitable, or at least positive free cash flow. Come on. So maybe is that a metric to look for, companies that are still burning cash versus those that are cash flow positive?
Yeah, for sure. And I think when you go back and you look at who have been the major winners in tech in the last 30 years, the common thread amongst all of them is they were cash flow gushers. So I don't care. Apple, Google, Netflix before it got into streaming, when it was just sending out DVDs by mail.
Salesforce.
Salesforce. People criticize Salesforce, like the old value guys used to say, they're not GAAP, profitable.
Right. Meanwhile, they were adding cash flow every month like crazy.
Huge.
Right.
So that's the common thread. So for sure, if you want to find companies today that ideally that are producing lots of cash as a signal of their future, but I would say that probably the better opportunities right now, where the people who will clean up the most at this moment, putting new money to work, is can you put your finger on the company that is burning cash, but everybody's getting it wrong, and a year from now or 2 years from now, it's going to start making tons and tons of cash.
In the mirror.
They were losing lots of cash, and then they flipped the switch. Tesla. This is what happened to Tesla. Remember, everybody thought, 2018, they're going out of business and all this. And
they have a debt payment due was like a recurring motif.
And suddenly 2019, they did $1 billion in free cash that year. And all the bears didn't see it coming.
So all that money all that money they were burning in 18 that the bears were taking delight in, that ended up being productive investment they were making?
Yeah, and everybody loves to dance on the grave of Cathie Wood, right? And kind of take shots at her when she's down. But do you know anyone else who, in size, had a trade on Tesla before that happened?
That Scottish guy, Bailey Gifford.
Ron Barron.
Ron Barron.
But
yes.
it's a short list.
Ron Barron. But so
it's like three
So
or four.
Cathie, I was looking, even at today's levels with Tesla, I think versus pre-pandemic, she's up like 18.5x on that Tesla, investment. So how many other investments?
She should have just stuck with that.
So Amazon was like that too. Remember when Barron's did the Amazon.bomb cover in the .com era?
John, we have that, right?
And
but
so
I don't know if you've ever seen this.
No,
this was 1999. This was one of these Saturday cover stories from Barron's.
All right, so they were right. If this is 99,
they were right
on stock price, not on the business.
They were right because they were burning free cash in 99 and all up until 99, and they didn't start going free cash flow positive until 02, when coincidentally the stock bottomed and started to take off a year before the rest of the market.
So what are some names that you think are in that category?
So for me right now, I think there are two stocks right now that are hated. If you go on FinTwit, the majority of people tweeting about them are saying they're going out of business.
That's your first mistake is going there.
No, dude, every stock is hated, so let's have it.
Yeah, everyone hates everything right now.
I'd say it's Carvana and Open Door. Right?
Spicy.
Those are the
All
two.
right, give me the case for Carvana. All right, so Carvana is one of the biggest stock debacles of 2022, and that's saying something.
That's got to be a 90.
Last August, I think
that
they
a
were
father-son founded that?
Yeah, exactly.
And they personally lost
Billions.
like tens of billions or something?
I don't know.
It's down 94.
I don't know. That means
94%?
Yeah.
Give it to me in points.
358 last August to $20 today.
Holy shit.
God.
And there was a story.
Now wait, hold on. This is leasing used cars or buying used car. Which is it?
Buying used cars.
Buying a used car
buying
online.
Or leasing. Basically, they've built these coin-operated dealerships.
Oh, yeah.
Right?
Are they building one on the Meadowbrook? Do you see that thing going up?
No. I hope that's not it.
I think that's what it is. Do you know what I'm talking about?
No.
It looks like a giant Legos
They're like big vending
Matchbox car.
machines.
It looks like a Matchbox car set on the Meadowbrook.
All right, but you don't actually put a coin in.
You do.
You buy a coin and
you go online. You buy the car online. It's sort of an online experience. But either if you're out in the sticks, they bring it to you on a flatbed.
But they do send you a coin, don't they? For real.
But yeah, if you're close, and part of the reason why they've been burning cash is they've been building all these coin.
Stop with the f***ing coins, maybe.
No, it's because the coins are made of palladium. The coins are made of palladium. Oh look, Jack. No, they are building that.
Yeah.
So is this this is for marketing purpose?
Well, you go there, you buy it, you stick your coin in, and cars start moving, floors start coming. The car
all right,
comes
so that's
down,
a 30-second experience. It's probably very exciting, but is that worth structurally? I don't know. Part of me feels like
the bears would
good.
say they've never made money. They've spending all their money on these stupid machines. What's their competitive advantage? But the fact
like
is,
Hot Wheels.
The fact is,
adults.
this was a darling amongst all the top growth tech hedge funds.
So what happened?
And
they started taking Bitcoin instead of the regular coin.
Inflation happened. I want to get out of long duration assets happened.
Cars. No cars happened.
Cars.
Can't get cars.
Perfect storm.
They went from like this used cars are worth more than new cars to like the world is ending.
CEO came out as a Trump guy. No, I just made that up. All right, so they had a perfect storm. It's like a terrible environment for them, but they continue to invest.
They're continuing to invest. They're cutting costs. They're cutting headcount. They have to rely on the debt markets because when people lease from them, they've got to take that. They've got to provide the cars.
It's car leasing business.
So it doesn't rising rates.
Cost of capital goes
rising
up.
rates kill them, no?
Right. Well, it makes it a more difficult business for sure. But so are they going to die? They've never made money. Yes, they have a great brand. People love the experience of buying the cars through them, despite the hokiness.
Do they get a lot of? Have they been around long enough to be able to definitively say that? Do they have repeat car buyers?
They're if you do a cohort analysis of people who bought with them and what they've experienced through different years, the engagement has been great and people have been very satisfied from a net promoter score and all this kind of stuff. And they've got a lot of adjacent areas that they could expand into.
So they service?
Swimming
they built
pools.
they built this footprint across the country of all these coin-out machines. They can get into new cars. They haven't been in new cars to this point. They can get into fleet management. It's kind of an easy expansion.
What's the other stock you said people should short?
Open Door.
Oh, another one. Okay, let's talk about this.
Open Door is sort of buying your house from you. Instead of you putting it on the market, go online.
Yeah.
Which
Zillow threw in the towel. They said basically
It's
we can't do it.
They said that, yeah. So they basically left the market to Open Door. And so
that's wild to me. That one company gets completely out, but that wasn't their core business.
No.
This is Open Door's core business. They better be good at it.
They started it, doing this in I think 15 is when they got founded. And the last couple of quarters, surprise, surprise, they've been free cash flow positive. Now, it hasn't been a huge positive because
how much is the stock
it's down 87. So this is interesting. Redfin, Zillow, Open Door, all crushed. Hottest housing market of all time. Not of all time, but hot, very, very scorching hot. Is real estate like undisruptible? Is that what we've learned, or you think they have a real opportunity? Because I think the broker, the whole process sucks. You would think that there's an opportunity, but maybe it's harder than it looks.
I think it all comes down to math and algorithms and how much risk they take, because basically they're buying homes, and then those homes are sitting on their balance sheet for a couple of months before they unload them to somebody else. So if you're not good at setting the right price and knowing
everything else that happens
and knowing that
after
you can get that 2 or 3%.
So Zillow lost $50,000 on every house on average. I forget what the number was, but one of the stories was that like things that they can't pick up in the algorithm is we've got a dog that won't shut up in the backyard. Right, that sort of stuff can't be picked up with a machine because they don't know what it's.
That made the house harder to resell, and the local brokers would say, the local realtors would say, we could have told them that.
Right.
Yeah, it's a classic John Henry man against machine story.
Yeah.
But if you get to scale, maybe it'll work.
Well, and that's been the criticism against Open Door all along.
Was this a Chamath SPAC?
Chamath
it was a
Open Door.
Chamath SPAC.
Yeah.
Is he still there? Is he still involved?
No.
He cashed out completely? Okay.
No, he's moved on.
Is that one of the things that was hanging over the stock, though, or?
I don't think it was
sure
that.
It helped in the beginning.
No, I don't think
it was a hot SPAC.
I think I think people soured on SPACs, so that hurt it. I think then people soured on housing, and that hurt it. And so
people have soured on everything.
Now, since the Fed made their announcement, like all the home builders are like way down in the toilet.
Home builders is down 7% today.
Oh, does this trade with? Should it trade with home builders at all, though?
I don't think it should, but it is right now. So like that's the way it's trading right now. So even if we go into this nuclear winter period for the next 5 years, let's say, in some ways, Open Door's value proposition is even stronger, because what they're saying to people is,
get out now.
We'll give you cash now.
We'll get you out right now.
3 days you can have cash, not 6 weeks, not 6 months. And we'll tell you this is what you're going to get.
Does Wall Street value this in part based on the values of the homes on their books, or they're not meant to keep these homes that long?
They've done a good job of churning through them.
Because I say, don't forget, they'll give you cash now, but then they also have something to sell into a down market. Like they have to sell the house.
Yeah,
I don't think they can hold it.
I think that's probably why the stocks.
They should just call BlackRock. No, I'm kidding.
If you're going to argue the bear case, you'd say like, well, how much do they have on their books, and the market's changing, so whatever they bought in Q1 or Q4 or whatever, they're not going to be able to unload it or something. But I think obviously time will tell. I think that they've got a great team, and this is all that they've done is build these models to give themselves wiggle room to protect themselves on the downside. And we'll see. They haven't gone through a downturn yet. So
do they need to raise money?
No, they've got plenty of capital. So it's really just if they're right, and so of these two, Carvana and Open Door, I have more confidence in Open Door. If they're right, that could be a Amazon.bomb. In the future. And if they really kill it, I mean, they could go from, I don't know what it is today, $4, $5 to, over $70.
What's the consumer acceptance of iBuying like? Because I think most homeowners, it's like not the first thing they think of. The first thing they think of is my sister-in-law is a realtor. So what is the penetration rate of? It's got to be tiny, right?
Tiny. It's
like relative to the housing market.
Yeah. And that's
the opportunity. That's the upside if you think it's going to take off.
That's the upside. And they're expanding like crazy. So they keep moving into more. They're in New York City now.
Maybe they should stop. Just saying.
But so we'll see. And they've got the market to themselves. They have no competition. Like Redfin, I think, was doing this, but now they've done job cuts. Zillow's out of it. I think there's OfferPad is out there, but
okay,
it's basically
so you're saying that at the prices these stocks sell at, they're almost call options,
right,
on the business.
Right.
It's amazing, relative to what their share prices were.
Right.
So I love this idea. I like that people are starting to think that way. Like, what does everyone hate because they misunderstand it? And there must be a lot of other examples. I was thinking about biotechs this way. I know that's not really your area. It's not mine either. Don't worry. But these are companies that raised a ton of money. We had a ton of new biotechs come public. There's a lot of capital there, right? There's not going to be a lot of drugs. There'll be a few drugs, but there's a lot of capital there. But theoretically, none of that should be economically sensitive or cyclical at all. We're talking about life-saving therapies and innovation in chemistry and protein-based stuff. Like what does Jay Powell have to do with any of that other than valuations? Those are not businesses that should be affected by the economy. Therefore, if you are looking for growth companies that are down 80, 90%, maybe that's a good place to start looking. Again, think about 2003. I think biotech beat the shit out of every sector coming out of that malaise.
Right.
Biotech in 2003, they got a new guy at the FDA. He started approving everything in sight. And those stock, I remember being in, what was the one with the C that everybody owned? Stock went up 10x or something?
Carvana.
Not Carvana, close.
Was the one Martha Stewart got in trouble with?
Celgene, yeah.
Oh, yeah.
No, M-Clone was part of that era. But there were stocks that 10x'd.
Oh, Biogen,
and
Regeneron.
a lot of them were biotechs.
Yeah.
It was, in other words, you lost the .com names forever.
Right.
There was no more Excited Home. Those were gone. But biotechs that had raised a lot of money in the bubble and just kept doing their science for a year, sat quietly, all of a sudden, those were like the hottest growth names. So I was thinking about that. I don't know. Do you play in that space at all? Not really?
I've tried to, but I don't think I'm smart enough, frankly, because
unless
unless you play the ETFs or something like that. What I found is that, how am I supposed to judge whether this thing gets phase one?
You got to take the drug yourself. That's really the only, in my experience.
Eric, did you listen to Aswath Damodaran with Patrick O'Shaughnessy a couple weeks ago?
No.
So I want to get your take on this. They were talking about what's going to be what's discretionary, like how does discretionary spending get affected by inflation? He said the money we spent. This is Damodaran. He said the money we spend now is on things we didn't have 40 or 50 years ago. We don't know how discretionary or non-discretionary your Netflix subscription is. We're going to find out very quickly. So much of our market cap comes from companies that provide products and services that weren't around 30, 40 years ago.
I agree with this take.
So we're going to find out how inflation plays out. Are you less likely to upgrade your iPhone if prices are going up 15 to 20% a year? Blah, 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 blah. Your thoughts?
I think he's right.
SaaS alone, in the GFC, there was no SaaS software that anybody was even talking about. I know it existed, but now we have 500 SaaS companies with 10 billion plus market caps that are making the case that everyone's going to keep paying these subscriptions. And we don't know. Maybe they will.
I feel better about those kinds of companies keeping their customers because they're enterprise customers. And they're
Salesforce,
they're stickier.
Nobody leaves.
Yeah, and
web security, Palo Alto, CrowdStrike, some of that stuff you actually can't stop paying for.
Yeah. No, yeah. There's a big difference between that and Uber Eats or Netflix, my subscription.
So enterprise is less discretionary.
Yeah.
Let's say.
Well, if you've made that investment, you've invested a ton into Salesforce or whatever. You've trained people internally. You'd have to
the switching costs are okay.
It's
so
switching costs.
Workday would fall into that category, or
but there's a lot of variation. Obviously in SaaS, and so you really got to drill into the details. But there's a lot of SaaS companies that came to market because they could and raised capital, but we're going to find that the smaller ones don't have the goods. But
DoorDash is the first thing to go in a recession. It's so expensive.
Do you think there's going to be M&A activity in that space? I'm going to ask you about activism
in DoorDash?
later. No. In SaaS, in software, I just feel like there's too many. I don't know anything, but it seems to me that we had 1,500 IPOs in the last 2 years. There are so many publicly traded companies that maybe don't need to be standalone and work better as a piece of a larger entity. And we saw like Slack get bought up by Salesforce. You think we'll see more of that?
Oh, for sure. I mean, I think Microsoft, Adobe, Salesforce. I mean, those are going to be the obvious buyers.
Are the valuations because none of these deals still, even at current valuations, would be accretive to earnings or anything like that. Like they're still expensive, even though they're down a lot, or maybe not.
Yeah, well, I have a friend of mine who lives out in Silicon Valley. He's just a venture capitalist, so he never looks at a screen. Like he's out there meeting his. It's always funny. Like when you go from the stress of watching your daily portfolio value to kind of meeting these VCs that just are just focused on I invest in companies.
Yeah, we know those
12 years from now, my client,
little
my
beach
LPs
volleyball.
Anyway, he's a super.
They don't have to mark to market, so every day is Saturday.
He's a super sweet guy, and he actually told me. I said, what public stocks do you like these days, Mike? And he said, Eric, I don't invest in public stocks. I
don't get my hands dirty.
And I said, why? Because he said, because in my line of business and being a VC, and he mostly does enterprise kind of software deals. The companies come to me; they're private, and they show me the full books. Right, and I can see how's the new cohort doing? What's the lifetime value of this customer? Are we seeing improving statistics in terms of over time? People really like this product and going back and using it or not? And then that's what we make our investment decision on. In public markets, the public companies,
the Fed,
they do their best to kind of shield all the proprietary information away from.
And then you have all these other factors. What sector's in favor now? Mm-hmm. So it's like. Michael's basically jokes. We don't really mean this, but the stock market is college, and private market's like kindergarten. So I know it's not really like that, but that's how it felt the last 6 months worth of companies that came public and were cut in half a week later. The first time they reported earnings were cut in half. It's like welcome to the real world.
So speaking of M&A, about this sometime this week, Cathie Wood was asked what risks to your strategy most worry you? And this rubs some people the wrong way. I understand. She said, the biggest risk is that our companies that have taken a beating will be taken over at current very low valuations, in which case we'd incur permanent losses. So we will fight tooth and nail against larger companies if they try and pluck these companies up for their superior assets at bargain basement prices.
So in other words, she bought something at 50, it dropped to 20, somebody acquires it at 30, locking in a permanent loss for her. I guess that is a real risk, kind of like a bond being called early or something.
I mean, I don't.
No one's gonna feel bad.
I don't get this quote from her. I mean, I'll defend her on a bunch of issues. I don't always see. I think most of the stuff that she's a very good marketer, and most of the stuff she says, there's a marketing reason why she's saying it. I think she's talking up the risk right now is not inflation, it's deflation. I think that partly because that benefits, the kinds of companies that she goes after. So I got to think that this quote is something, it sort of shows her investors or potential investors that she's, I don't know. She's
There's
really
so much value here that somebody else is about to come steal it from us.
If Zoom, one of her companies, got taken out tomorrow for $150, she'd mark it up, and then she'd use the cash and she'd invest it in some other stock.
Zoom actually recently became a bigger holder than Tesla.
Zoom's a cash flow company. It's one I'd put in the quality tech cash flow company for sure. It's one I own.
What's the problem with that? There's no differentiation. Google Meet is just as good.
Well, everyone said that. I mean,
I feel that's true.
But
though.
I feel like they're still the dominant player. People love the product, and they have other adjacencies they can get into. They're getting into kind of call centers and phone and more office software kind of stuff. So they're the
what's the market cap on? What's the market cap?
30, I think.
Is that it?
Yeah.
I mean, it got smushed.
Yeah. It
went
from 580 to 85. Now it's about 104 or something like that.
Could Microsoft potentially just say, let's just make Zoom part of Teams and
Zoom's
just do this?
Zoom's $30 billion. Why couldn't they get bought? Slack. What was Slack when it got bought? Slack was, I'm guessing, $20 billion.
Zoom has hundreds of millions of customers. Is that right?
Yeah.
Is that? It's like a very, very big number. I don't know how much they're getting paid by all those customers.
Yeah, a lot of those are small, one-person enterprises.
But so what?
But their last report was a disaster. Their growth slowed pretty dramatically.
Stock went up though. I think because it went because they.
I think they beat on revenue.
They had big cash flow. It wasn't as bad as people feared.
I wanted to ask you about this one. what about DocuSign? That has been, we're DocuSign customers. Everyone I know is a DocuSign. I know Adobe competes, but like if you say to somebody the same way, let's do a Zoom tomorrow, it's the same thing.
DocuSign's a verb.
I'm going to DocuSign you something. I need you to sign it. Like
60 billion to 11. Oh
this
my
is an 11.
God.
It's 11 billion on market cap.
Let's buy it right now.
They should first of all, the CEO should be gone, and somebody should just like step in here and fix and like stop the bleeding. There's no reason for the carnage in that stock that I can think
Are we
of.
getting to about the activist investors? Where are they?
We're going to do that later. We'll do that later.
Yeah,
what do you think about this
DocuSign?
name?
Yeah, that's a good case study. Zoom versus DocuSign. Like Zoom is
Same chart.
Both verbs.
But Zoom's always been a cash flow positive.
Do you
even
think
before.
what I'm thinking? DocuZoom? What's up, motherfuckers? You guys, what do you think? What if?
I'd buy it.
What if? They'll probably go right to zero. Okay. All right. So she did know the Tesla call. You're right. She is a great storyteller. The team that's unusual in their backgrounds. So what does that mean? She found really talented researchers, many of them from Twitter. Is that what makes them unique? I'm trying to figure out like what's the unique part.
I don't know. I don't know all the team.
I hired half my people from Twitter either. Also, so don't. I'm not saying that as a diss, but is that what's unusual about it?
Well, she's always been unusual. Like, before the Tesla call, like before she made all the money and had all the success, people hated her on Twitter. Like, again, that might be FinTwit, but every time she'd go on CNBC and talk up Tesla, and she'd throw up big price targets for Tesla.
That's what pissed people off.
That's what made people.
Eric, her base case for her bear case, I believe on Tesla was a $2 billion market cap. Her bear case, that's not serious, right? There's nothing wrong with being bullish, but to have a bear case at $2 trillion.
Eric, you said that there's a little bit of sexism and ageism, maybe even if it's unintentional, in the mix here. You noted that Morningstar criticized her this April for being 66 and not having a succession plan. They don't do that with 66-year-old men that I'm aware of.
That's true.
I never hear about a 66-year-old hedge fund manager, for example, that how dare he not have a successor.
Right.
So I think there's something to that. But I also think that there's a contingent of people who, when they hear that claim being made, they just have this like really violent reaction like, oh, now it's the woman card. So it's really, really hard, I think, and she, to her credit, never does that.
No, she never plays that. I mean,
Never.
she was asked point blank by Bob Pisani on
I give her credit because, not that I think other people would do that, but it's like it's in the arsenal if you want to use it.
You never really.
It's always there.
Yeah, to her credit, you do really. At least I've never really seen her address the haters, of which there's an army of them.
Because you can't.
No,
I have some. Yeah, go ahead.
But I'm interested in growth tech stocks probably for the same reason that she is.
Yeah.
Which is that. I remember when I started my fund, I said I was going to invest in technology. People said, "Oh yeah, you're going to invest in FANG? Is that what you're going to invest in?"
Yeah,
and I never had an interest in investing in FANG, not because they weren't great companies, but because it's an acronym. So the money's been made. And the law of large numbers is kicking in.
Can I go ahead? I'm sorry.
Last year, I mean, they had a great year, and everyone was saying, "Wow, that FANG's where it's at and stuff." But now, we're seeing that
the acronym is that's such a good insight. I remember the bricks,
right?
Like you had to be in the bricks,
right?
Literally, by the time everybody was talking about the bricks, nobody's made money in 15 years since.
Yeah, you're
it's
totally
incredible.
right. So I want to find the next acronym. Who amongst the DocuSigns and the Zooms are going to be the next?
Let's just make one.
Next acronym. So
let's take those cash burning companies that have all been like thrown out with the bathwater, and let's come up with an acronym. And they may not work, but at least we could market the acronym.
When did Kramer come up with FANG? Was it 2016?
It was 2015, I think. It's a while ago.
So we should do that today, and then we should plow the money in and then ride it for the next 5 years.
An ETF to license it, and we're off to the races almost no matter what happens.
I have a little bit of good news. Finally, interest rates are coming down.
On what?
On interest rates.
Oh, bond yields are coming down, you mean?
Yeah.
Okay.
But with Cathie, I respect her. And one thing that amazes me, though, is that she's had positive inflows this year. And she's still up. She's at I think $7 billion now in the core ARC fund, and it was like $1.8 billion at the lows of the 2020 pandemic.
It was $30 billion a year ago.
Yeah. Well, no, obviously.
Yeah.
But my point, what amazes me though, is that minus 77%, and people are still putting money to work, and it's mostly younger people, and so. you say what you want about her, but she's put her finger on a corner of the market, and she's articulated it, and she's put it out there, and there are a lot of people that are interested in it.
She also is of the internet age, so she has global fans right out of the gates, even in places where they can't access her funds, people know her in Korea, they know her around the world. I think what's different, so she might have a really big comeback. Like if interest rates stabilize and some of these companies that she's in start to like really crush it and show that the money burning they were doing actually had a payoff, that it's possible, but there are other comebacks on Wall Street where people aren't coming back from negative 80%. Like Buffett has had really rough, he doesn't care, but like he's had Barron's write the shitty article about him, how he's done, and has had the comeback. But he wasn't down 80%. This is a lot to come back from.
It is.
Yeah.
But
if you just buy the fund today, you don't care about that. But if you're her, it matters.
For sure it matters. And for sure, no investor likes to lose that kind of money. But
Michael does. Most investors don't.
But this is the most volatile, subsector probably of the entire investing universe. So if there's anybody who's going to have a comeback, it probably will be from this.
I like happy endings for people, so I would root for that.
Just the destruction is so severe. ARK could double and still be down 50% from its highs. And it probably will get a double, right? It'll probably go up 100% at some point.
Well, she's in the types of stocks that could double.
If inflation slows down at some point, these stocks will double in 4 months.
Yeah. I was on a webinar with Mike Wilson from Morgan Stanley, who's kind of like the bear right now on Wall Street from a macro perspective.
Shout out to Mike. We like Mike.
And by the way, he keeps saying like 3,400, 3,500. I'm not buying till then. If we have a couple more days like today, we'll be there. We'll be there. But I remember I asked him about when things do bottom, what rallies first, and he said it'll be the growthiest part of tech and the small caps.
Well, first in, first out, or first out, first in.
First out, first in.
Yeah, they've been getting killed since
February
2021.
2 years.
Yeah, for sure.
February 21. That's right.
Yeah.
So speaking of the bears, layoffs in tech. This is like another natural part of the cycle that you've seen multiple times. So have I. It seems like it's just starting.
It's coming in hot.
But these companies are not wasting any time. Like these are 10% workforce reductions as like the appetizer. Like they're not taking their time and seeing what happens. They're acting decisively. How do you see it?
And unfortunately, they're probably a leading indicator for other companies down the road, like 6 months from now.
So Armstrong at Coinbase is a very big layoff. Is it 18% of workforce? Mm-hmm. So. All right, so Coinbase, Netflix.
Wait, sorry, let me just jump in. So Balchunas just sent this to me because I asked. This is ARK flows, so it's pretty noisy. But year to date, 1.5 billion in inflows. That is very impressive.
For sure.
Never happened. I've never seen that before.
I would love to say I would love to see like a breakdown of like the demo of who's investing this year. But I would think it's skewing younger. Like she's sort of capturing. She's got her brand, she's built it, and she's communicating it, and people believe. I think
it's probably a lot of people who were originally in the fund when it was going up, and they remember that this is possible. Like so, I don't think it's new people. I just don't.
6 days ago,
I'd love to know.
6 days ago, there was on Hacker News, Coinbase employees petition to remove execs, and there was, people piled on. The thread goes on for 6 miles, and Brian Armstrong did a whole tweet thread. This is really dumb on multiple levels, and he goes on and on and on. And then 5 days later, big Coinbase layoff announcements. We were speaking about that when they reported earnings last week.
He was refuting that there were going to be big layoffs, and then they did it?
No, it was just employees calling for executive change.
That was him? They want him out?
I didn't read. I'm sure. That was June 10th.
Who do they want in there? Do Kwon? Who do you go to?
I think they were complaining like these guys cashed out after the IPO.
True. They took a lot of money out of the company.
He bought some big expensive house.
But I think over the last year, they went from 1,000 to 3,500 employees. And the stock-based comp, we spoke about this after they reported earnings, was absolutely out of control.
Yeah, it was like $300 million. It was like something insane
It was a joke. I think it was 250 for the quarter. Maybe they were projecting 900 for the year. I don't know. It was outrageous.
Right. And that's something that we all lost sight of over the last couple of years, and those are real costs. The stock-based comp issues, and that's probably going to be a rolling problem for a lot.
Yeah, it's
of
not
tech
just
companies.
an accounting. It's not just an accounting figure. It's an actual cost to the company,
Right.
while the company's not making money.
And shareholders, especially.
Right. But now employees this year, when there comes bonus time, or
The options reprice.
hey, you're going to take your bonus this year in cash or stock.
Yeah.
Oh, I'll be taking it in cash this year. Well, then that's going to have a direct impact on the company's financials.
These are the layoffs that we've got
That's
so far.
interesting. So now you have people that are like, I'm not going to ever make that stupid mistake again.
Right.
Give me the cash. The companies actually have to give you the cash.
Yeah.
They can't just issue
every
stock.
company's different. I mean, but there are a lot that give that kind of a choice.
Okay. Oh, I did this. When was this? Oh, Q1.
Look how fast this guy is.
Good job, John.
Very impressive.
350 million. Oh my God.
This is the first quarter of 2022. This is Coinbase stock-based compensation. $350 million for the quarter.
I mean, come on. So this is why it matters. We spoke about this a while ago, that the market is the economy for some of these companies if their shares are their currency for hiring employees. It matters a lot.
Right.
So some of the layoffs that we've seen so far: Peloton, Wells Fargo, Robinhood, Netflix, GoPuff, Facebook, OnDeck, Carvana, Twitter. I mean, it's everywhere.
It's becoming like pretty pervasive.
Yeah.
I mean, you could say, hey, good for him to do it, take decisive action. But then you could also say, why did you have all those people in the first place?
Why did you hire them?
Why did you need whatever it was?
And they weren't hired 5 years ago. They were hired like 6 months ago.
Right. And I saw something when the layoffs were announced that as late as January of this year, they were offering senior engineers new packages, hiring them for $900,000.
Yeah, why not? The investors are paying for it.
Doesn't that speak to? We mentioned the Redfin layoffs. What's WBD?
So Warner Brothers Discovery. By the way, all of these media stocks hammered. Paramount's down like 75 or 80%. Imagine
They all look like Peloton.
Imagine Maverick didn't make $1 billion. So
Disney,
exactly. Disney, Warner Brothers Discovery, they are laying off 30% of their ad sales team.
Yeah. So
doesn't this speak to the speed at which the switch was flipped? If Coinbase was doing what you said in as recently as late January, that feels like yesterday to me.
Right.
So it's amazing how quickly all of this is which was my point. Like, they're not waiting and seeing.
So how quickly does the tight labor market untighten?
I think we're going to see it pretty quickly. I mean, I think and the Fed is doing all this stuff to slow things down, and it's hard to say. Are they? I tend to think like there's a lot of stuff would happen anyway in response to like all the stuff that's gone on this year, aside from the Fed, that's slowing things down. And so I think a lot of CEOs are just looking at how much cash do I have on hand, what kind of, what's my stock price, what kinds of calls am I taking from my investors, and they know that if they don't act, that they're going to be in some serious problems.
When did Uber's CEO come out and say, "All right, game changed"? Cash flow. That was the first quarter. That was like 90 days ago, not even maybe.
Yeah, no, I think it was more recent.
It happened so
like
quickly.
a month ago. Or
so
something.
6 months ago, everything is happening so quickly. 6 months ago, housing was unaffordable. Now it's really unaffordable. You couldn't afford the down payment. Now you can't afford the mortgage.
That's the weirdest part about this thing, especially when it compared to .com, is that things seem to be going much faster
Yes.
these
I agree
days
with you.
than that. Like back in 2000.
I wonder if there's empirical data on the pace of layoffs from back then that we could. I'd be really curious if it feels that way.
And back then, tech was not this behemoth in society, right?
No.
Because like people were kind of mad at Y2K back then.
Yeah.
Like, that was a fraud, and the internet. Oh yeah, people got all excited about that, but a lot of people weren't using the internet. They weren't going home to their AOL dial-ups.
Employment. How many people work for Apple and Alphabet and Facebook? These are enormous. Amazon's
millions,
as big as Walmart.
Right.
These are the biggest employers and probably the fastest hiring employers in the Fortune 500. So actually, what happens with stock price becomes more impactful in people's lives now than back then.
Right. So that's why I wonder
how many people worked for Yahoo in 2000? A lot, but not that many compared to now.
No.
Right.
So if we're a year and a half into this correction for a lot of those tech stocks that you had up before,
February 21
like
being
80,
the top.
90%, like it's are things moving faster? Meaning like we don't have to go through a 4-year, waiting period like we did after the .com. Like are we going to move through this even faster? And as amazed as we are now talking about these layoffs versus 6 months ago, 6 months from now, are things going to turn again? It's always hard to see that in the moment.
Yeah.
But the people that are going to make the most money right now are thinking a year from now.
I'll tell you this much: 6 months from now, you're going to hear a lot less people fighting over whether or not they could work at home. You'll be like, right. I will take the job, sir. Yes. I will see you Monday morning.
Do I have to relocate? Okay.
Okay. Right. Where do you want me?
Right. San Antonio, sure.
Let's do crypto. What do you have in here about Sam?
Well, this goes to the layoff thing.
Yeah.
Sam Bankman-Fried, he was interviewed on the SON conference, which they did remote again this year. Surprised me.
What are they doing? Just do it already.
If you haven't seen it, you should go to YouTube and watch this interview, because it's Patrick Collison, one of the co-founders of Stripe, who's interviewing Sam Bankman-Fried. And I first thought he was lying on a bed with his MacBook like on his chest, in a t-shirt.
Was he on his beanbag?
I think he was leaning against his headboard or something like this. But doing this 45-minute discussion to SON in his t-shirt. Okay. But anyway, super smart guy. I really like listening to him. But one of the most interesting there.
This guy's the best.
He's so unintentionally funny. Maybe this is intended. I don't know, but he's very entertaining.
But the most interesting part of this interview was that the guy Patrick asked him, how many engineers do you have at FTX? Big company, right? And he said 24. And
it's not a lot.
No, it's nothing. And he said, why so few? And he said, well, I believe that just adding headcount for the sake of headcount does not make the company more productive. In a lot of ways, we think it makes us less productive. So we'd rather have a much smaller team. And he thought that all the companies like Google and Facebook and Coinbase, I'm sure he didn't name Coinbase, are overhiring basically,
bloated,
and it's also a status thing, right? Hey, I work at I work at Facebook. I'm part of this huge community or town or something that works here. So he said if he ran Facebook, he'd probably employ 10% of the number of engineers that
That's
they have.
crazy. Yeah, and the job market will say, "Oh, thank God, we'll take them. We'll take a Facebook engineer right now." But part of that is also, when you build a large company, you don't want to hear about things taking 2 weeks. So you're a senior VP of whatever bullshit, but you're like, I need this like next week.
Right.
You want a team of 30 engineers swarming that project.
Right.
You don't want to be told we have some people working on things, and you're gonna have to wait for that.
And you think like, hey, I'm Facebook. Why shouldn't I have
Facebook.
this team?
How do we not get this?
Get more people then.
Yeah.
Like let's solve this problem. But
it's not easy.
But then you got to train them, and
He did a tweet thread on this the other day. I thought it was spot on. Just hiring is a distraction, because training, and oftentimes people think, oh, I have so many other colleagues, it's somebody else's responsibility. The leaner it is, the more focused the team is.
But what do you do? But what do you do? Listen, we struggle with this. Like we've been hiring like crazy. What do you do? Do you slow down the rate at which you're handling things for clients and employees from an engineering person? Like, what is the drawback to saying I would run this leaner? Do you make your people work more hours and pay them more rather than having another body? Like because I'm trying to figure out how I can get more out of Duncan, candidly.
Well, I mean, he was talking specifically about engineers, and so
he's our audio video engineer, sir.
And I remember one of the questions was, do you just hire for IQ? Is that all you hired for, to have the best team? And and he said, well, it's an important factor, but it's probably like 20% most important. And the most important thing is, we have to hire people and we interview for people that can basically just deal with a lot of ambiguity, because there's never a clear-cut answer in our business. And a lot of times these engineers are like writing code, and some of them will get really fixated on it's got to be just right. It's messy code, and I have to clean it up. I have to take a little bit more time. And he was saying like
you hope that's the case, for example, with like nuclear missiles. Like you hope, right?
At FTX, it's not such a big deal, but basically hire for those kinds of people rather than just.
Would you bet on Sam Bankman-Fried coming out of this in better shape than Brian Armstrong, for example? Like not personally, but like the way
His
that
company?
the way they're leading their organizations. Like which one would you prefer to bet on? You can't bet on FTX.
Is this a
You
joke?
could bet on Coinbase.
Which would you bet on? The guy that has 24 engineers or the person that just laid off?
Okay, but there's more to it than how many engineers somebody has. There's competitive position. There's what stadium do you?
Are you going to bet on a
own the rights
bald
to?
man
All
or
right.
a man with a beautiful head of afro?
That's true. That's true. I don't know. What do you think about that? Too
Yeah.
soon to tell?
No, I for sure would bet on Sam.
Don't you think either of these two guys, though, if they weren't in crypto, they would like be successful in no matter what? Like they just seem to have that thing about them where they both can see the future and then also execute faster than anybody else. That seems to be what they have in common.
Yeah, and I wouldn't bet. You talk about one of those cash burning ideas that might turn out to be a great idea. I mean, I think something good will come out of crypto, out of all this, despite like everyone wanting to say
By the
this
way,
thing was just a hoax.
If you don't think crypto's a zero, and I am definitely in that camp of not zero, Coinbase could be very cheap right here. Or not.
Not zero
But,
is a super bullish posture.
No,
Are you
but-
sure you want to
yeah,
get that carried
no,
away?
I'm being very adventurous by saying that. But what's the? I mean,
I looked it up, and they're on a multiple basis. They're as cheap as Schwab, but
the business is
problem
not as good.
the problem is they're charging enormous fees right now, and those fees
that are
gonna
going
get-
to compress.
Everyone knows that.
No one's gonna trade at those spreads and those fees. Everyone knows that. And one day Schwab will be their competitor,
Right.
as will Fidelity. Like if this was really going to be a thing, they're not going to compete with FTX. They're going to compete with.
You know what was a thing like 6 weeks ago? Well, how much is Coinbase's venture arm worth?
Not much. All right, much less today. Michael Saylor's margin call. Do you see this as like one of the most exciting will they or won't they situations in the market right now? So let me set this up. This is what is this? Quartz? All right. Bitcoin needs to cut in half for around 21,000 per Bitcoin before we'd have a margin call.
It's at 21,000.
Pause. That's the CFO of what's this company called?
MicroStrategy.
MicroStrategy in May at Bitcoin 40,000. So now we're there. Where are we?
Bitcoin is
21,500?
at $20,999.
Okay. So now we're there. But he said that. The CFO said that publicly. All right. In the 2 months since MicroStrategy's latest Bitcoin purchase, it lost more than half its value. As of June 14th, MicroStrategy has lost $1.1 billion on its Bitcoin
Who's
bet.
their counterparty in this?
Silvergate.
Okay.
So best of luck. According to the terms of MicroStrategy's loan agreement with Silvergate, a margin call would be triggered if Bitcoin falls below 21,000 per coin. Here, throw this up, John. The first chart is, so this is just like a quick history of when they bought it. They started buying it, pretty good. Fall of 2020, timing was impeccable. It goes crazy. They buy another billion at 60,000. Bitcoin falls to 30. Then it goes back to 70,000, and they buy another. They're up to 3 billion in purchases, and a lot of which is now borrowed money. And then they just did another purchase somewhere in the mid 40,000s in 2022.
I'm guessing they're done, right? They have no more money. Nobody's going to lend them any more money.
Okay, so you would guess that. That is not
what's their market cap of MicroStrategy?
It's tiny.
The company.
I think it's way below.
Okay,
the 4 billion.
So now, next chart. They have now lost more money in crypto than they've made.
Wow.
So I thought this was unbelievable, actually. So they had bought more than $1 billion by the end of 2020. Then the price went crazy. They bought another $1 billion.
So wait, their unrealized gains was almost $5 billion.
At one point. So
All right, listen, you win some, you lose some.
They have spent more than $4 billion on Bitcoin, which is more than twice as much as the company's $1.7 billion market cap. So there's a lot of money that maybe we're talking all this shit. Bitcoin could be 50,000 tomorrow, for all I know. I don't even know what it trades based on. But this is a pretty remarkable situation, right?
It's crazy. I mean, he's become a bit of a punching bag now in the media.
Well, that's how we're. The bigger of a personality you are on the way up,
yeah,
the more that will turn against you on the way down.
So the market cap is 1.8 billion. The enterprise value is 4.2. Their value of their crypto is what now?
I don't know, but they've spent more than $4 billion on it, and it's not that much.
They've spent more than $4 billion. Their enterprise value is 4.2.
and it's and they have losses.
Well, their average cost is in like the 40s or 50s, I think, based on courts.
He put up a new laser eye profile pic on Monday, though, I think.
Well,
now I'm bullish again.
Bullish.
He's still tweeting one BTC is one BTC.
Do you think that any of this stuff matters to the overall economy, or it just never got big enough? Crypto is now slightly sub 1 trillion in total.
I think it could go to zero and it wouldn't impact anything. There's not enough margin outside of crypto for it to matter.
I don't know. It's a lot bigger now, obviously, than it was.
Tesla has 60 billion in Bitcoin, right? Is that not 60 billion?
I think they sold some, but yeah, I think they still have some.
But out of all the publicly traded companies, I don't know where 60 is not the number. Out of all the publicly traded companies, they had the second largest amount after MicroStrategy. So it does matter to some, I guess.
I think it could. I mean, it does worry me that, I saw just on the way in here that some crypto hedge fund, didn't meet a margin call today or something like that.
3 Hour Capital, that was the talk the last 48 hours.
Didn't meet a margin, but who is the margin loan provider for a crypto hedge fund? It's nobody systemic.
Yeah, no, I know, but I guess
it's not Goldman Sachs.
I just, I worry that there will be some follow-on effects. If nothing else, even at just the consumer level.
Remember how everybody was like, "Ha ha ha, subprime! It's this bizarre little corner of the market. Nobody cares.
It's contained.
It's ring fenced.
Right.
Greece. Nobody gives a shit.
But subprime and crypto are very different.
All right. Anything worth saying about the Fed? Yes. The Fed's announcement yesterday. The market reaction today. Any thoughts that maybe people should consider?
I wish I had some great insights. I mean, the whole.
It's not your. It's not your game.
The whole last few months just feels like schizophrenic, where it's like one day, hey, it's great, and the next day it's like the walls are falling in, and even after the last Fed meeting, like we got the 90 minutes or what 90 minutes of like a rally, and
huge,
and then 5 or 6 days of
same thing today,
relentless selling, and so I hope we're not in for 5 or 6 days.
I think the entire game going forward, the only thing that matters is inflation. I think that even bad economic, so we have yet to really see the bad economic data show itself. I think bad economic data will be cheered by the market because it'll be a sign that inflation is coming down.
Yeah, I think so. But
what if he's doing what Armstrong is doing? Here's the new thing I'm hearing a lot of people say, oh, the Fed is front-end loading now. Okay, first of all, they're not. They're a year and a half late. But fine. The bigger cuts are going to be earlier this year, which will allow for more flexibility later, with bigger hikes are earlier in the year, and then the smaller hikes can come later because they already got the big ones out of the way. That's what people are saying now. Maybe that's wishful thinking, but maybe that's the same kind of approach. Like, if you're gonna eat shit, don't nibble.
Right.
Like if we're gonna do this, let's just get it done. Maybe this will be the biggest hike that we've seen, and then they'll like take some time to watch as this stuff takes effect. Mm-hmm. I don't know.
Is there any doubt that rates are going to come back down? Like they're going to come
eventually,
back down.
Yeah. I mean,
when they crush the stock market to Dow 10,000, I'm pretty sure they'll be cutting rates.
And if like there are more waves of Coinbase layoffs and all this kind of stuff, obviously for sure, there is going to be an impact from all of that.
Oh, can you tell me about what is the deal with mortgage rates and with interest rates in Canada? Is it like they had rates at 0.5%? Like they had rates like super low, and mortgage rates reset every like 5 years or something. What's the difference? Why was there so much speculation in the Toronto housing market versus there was a lot of home price appreciation here, but where you live, it's apples and oranges.
Yeah, it's.
Who controls the Canadian? Is it Wayne Gretzky still? Who's in charge of all this?
Who's the most popular guy? I don't know. Probably
Kevin O'Leary.
Andrew Wiggins.
Kevin O'Leary. Kevin O'Leary. I think he caused all this housing issues up there. No, it's they don't have 30-year fixed up there. Most people just do short-term, 5-year mortgages that they renew, always sort of tied to the interest rates at the time. And so most people are on adjustable rates because they're cheaper. And so it's that all factors into then why movements of the interest rates definitely drive the housing market up there. And so there has been a frenzy up there. I don't know if it's been that different than pockets of the U.S. that have been hot as well. But it's been a hot market for a while. The last time Toronto had a downturn in housing was probably the early 90s. And it lasted for 18 months or 2 years or something like that.
It's still a very international city. It's an innovation center. People want to be there.
They get a lot of foreign buyers that come in. But I think the biggest thing that's been supportive of the market has been immigration. There's like all the while that Trump was keeping the immigrants out, the doors were
Howard Lindzen said that.
Like
a lot of smart people were going there.
And when the people come, they have this point system where they don't just take anybody. They have this ranking system to try to take the brightest people. And when they come, they mostly want to come to Toronto or Vancouver. Okay. And so you basically have all these people coming into the city, pushing up kind of demand for housing. That's pushes the prices.
Let's
up.
have some fun. Let's do some of your favorite stock ideas. For the second half and for 2023, I asked you, but you could just go like whatever stocks you want to talk about. I always find that your takes on growth companies are fascinating, and I learn a lot from listening to you. So we did Zoom already. Mm-hmm. We did Open. We could skip those two.
Yeah.
Farfetch.
China's interesting because it's the only place in the world right now that's easing. It's not hiking. And so that's why a lot of people are very, bullish on Chinese internet stocks, some of which
this week
have been killed 75% or something like that. So they've had more of a beating. I like Farfetch because they have, it's a London-based luxury e-commerce platform, but it's obviously got a lot of exposure to China. And it's been killed. It's down like 90%.
They're selling into China.
They sell into China. They sell globally.
Yeah, I see their shit.
Because it's luxury.
What is it? Luxury what?
It's whatever you want: handbags, shoes, dresses.
Is it pre-owned or just better prices?
No, it's new.
Is it real shit?
Yeah, it's real.
Okay.
So they have partnerships. They just did a big partnership with Neiman Marcus to basically kind of e-commerce, the Neiman
That's
Marcus.
what the department stores should do.
Yeah.
They're doing a pretty good job with e-commerce, but they should really go to experts to do this stuff.
So because they have so many buyers in China, because people there love luxury, they have the exposure to China, and they've sort of were, penalized for that on the way down when China was, taking all their, DD to the woodshed and all that kind of stuff. But now I think they can come back on the other side.
What percentage of your portfolio right now is in China-related stuff? I know
Very
you know a lot about that market.
It's very low still.
Okay.
Because right now I have Farfetch. I have got one other name that I have, sort of starter position in.
What would get you more bullish on going back to the names that you knew about? Like you knew Alibaba 5 years before it came public. Nobody knew about it when you knew about it.
Yeah, to be honest, I've followed it, but I've never trafficked in the public stocks just because I've always, there's always been this regulatory risk that one day they could wake up tomorrow and totally
we've seen that with a few companies.
Not just their regulations, they could get rid of this VIE structure, which is how they become a Cayman's entity and list as a stock through that, but you don't actually have any control of the business and all this sort of stuff. So
what's Fryer Battery? Tell us about this. This sounds interesting.
It's a SPAC that doesn't make any.
Just kidding.
It's pre-revenue. So why wouldn't you love it in this environment?
Pre-revenue SPAC. Tell me all about it.
But they make EV batteries and other.
Wait, it's a SPAC that already closed its deal?
Yeah.
So where is it now? $4? $8?
$7.
$7. Okay. All right, that's close.
Better performing SPAC.
Yes.
But so basically, it's a Norwegian company that's building a bunch of huge gigafactories to build batteries in Norway, and then they just did a JV with Koch Industries to build gigafactories here in the U.S. And the reason why I think that's important is that despite the pullback and
we're still going to need that stuff.
We're going to need electric cars. And right now, if those car companies, whether it's GM, Tesla, who have Lucid, if they want to buy batteries, chances are they're going to be buying it from a Chinese-based
they
battery
seem very
maker.
intent, though, on also wanting to develop their own at some point. Is that not realistic?
Tesla?
No. No. GM, Ford. They're making noises about doing their own battery technology.
Well, they'd be smart, but it's probably a long road. So Friar's interesting because they've done a licensing deal with an MIT company that has sort of established technology, and they're domiciled in Norway and the U.S. So I think a lot of companies are going to be interested in doing business with them. So but
non-China outsourced batteries.
Yeah, if you think that we're going to have to, buy batteries from a Western supplier. There aren't many to choose from, and so that's why I like them.
You call that a wild card. When you get involved with something like that, what's your return expectation? You need like a 10x on something like that to justify the amount of risk you're taking, not really?
Yeah, well, no, I have to see that in the blue sky scenario,
no, not that it's going to happen, but like it has to be a possibility.
A 10x has to be a possibility, yes, for sure,
because you're bearing a lot of risk, so there has to be that potential upside.
Yeah, for sure.
Okay. Bombardier. What is this ticker symbol? It's on
the OTC and down here.
Okay.
So
BDRBD.
Yeah, Bombardier. So there's
what did I say? Bombardier.
They're up in Quebec. Up in Quebec. So they're one of basically 3 private jet makers in the world. So there's Gulfstream, there's Dassault from France, and then there's Bombardier. And so right now, they've got the jet that goes the farthest. So you could fly from Toronto to Phuket, Thailand, nonstop.
Which I'm doing very often.
If you're going to drop $75 million on a new plane like Chamath just did a few months ago, one of these planes, that means a lot to you. So they've got a huge 2-year backlog.
I'm happy for Chamath.
So I think it's interesting because if you compare it, it's more of a value play for me. If you look at them versus Gulfstream or versus the one in France.
There's the 2-year waiting list for this jet?
Yeah.
Okay.
And so it should be 3 or 4x where it's trading now. But it's got
Holy
high
shit.
debt.
Look at that thing.
Yeah.
It's beautiful.
So
down 50%. The stock's down 50% this year. Just hit a 52-week low list. Okay, so this is the kind of stock that if there's going to be a bounce in these types of names, this will participate.
Well, it's a little bit different because it's sort of under the radar. Like in my opinion, it should have doubled. Like if you'd asked me 6 months ago, it should have doubled or tripled by now. But nobody knows about it. They need to keep churning out EBITDA every quarter.
But they also need a stock market bubble to sell a lot of jets. Because that's what sells jets.
Yeah. Well, yeah. I
didn't even say a SPAC bubble. I'm just saying they just need a healthy market.
But I guess one of the things that has been helpful for them is that one of the impacts of the pandemic is that there's the ultra Chamath rich, and then there's the next level below Chamath. And some of those people haven't had private jets up until now.
Yeah.
But during the pandemic, they had to dip their toe in the water, right?
Yeah.
And then they probably liked it, and they don't want to go back to flying business class.
Are you a member of any of those private jet sharing things?
No, but
the economics of those are just not good still.
Yeah, they've been popular.
Yeah.
So
I don't understand who's paying for that. I would never pay for that.
I have a private Jeep Grand Cherokee.
Yeah. No, I looked at all of them. Not that I'm traveling that much. I used to. I guess I looked at them in 19. Mm-hmm. The economics were terrible for the user.
Right.
Unless you're really, really traveling every week.
The ones that are stocks have done terribly.
Awful stocks too. Yeah. I wanted to finish with 2 things. We could do these really quickly. Where are all the activists? Who's gonna step in here on tech? Not even crypto, but regular software stock down 60%. I understand it's macro forces that are doing this to a lot of the companies, but
yeah, what's Ackman doing?
But where are these guys? Isn't this prime time?
Well, 2 things. One is that when the economy goes bad, the activists typically pull in their horns, like after 2008. I don't think
Isn't that backwards.
Yeah, but I don't know. It's risk aversion or whatever, but I don't think you really saw activists jumping in until 2012.
Icon's been pretty counter-cyclical, though. He just closed out a position in Cheniere Energy, where he's in the process of closing out, taking his guys off the board. He got in that in 15. It was almost bankrupt.
Yeah.
He got in there. They put somebody new in charge. That stock has gone up so much, it's incredible, LNG. And now he is removing himself from it with oil where it is and with transmission assets worth what they're worth. Right. So he's been pretty, I think, adroit.
I think he's.
What are you saying?
ADROIT. Adroit?
We say adroit.
I say
in
adroit.
Toronto.
What was I saying?
I've never even heard that
You were
word.
trying to the French pronunciation.
Don't make fun of me. I learned it by reading. That's why I don't know how to say it. So you think
I think Icon's been the best activist.
I really do too.
Of the bunch.
I love him. I really do too.
But I think tech has been a terrible place for activists to apply their
I don't
trade.
know. So take that back. Icon alone. Apple, Netflix, eBay, PayPal. I think he's made some money there.
I think if you asked anybody who worked at the company, they'd say, "What did he really do?" It was more of a distraction.
He forced PayPal spinoff.
Made
he did do that.
Made Apple pay a dividend.
And
made Apple do a buyback and dividend.
What
Tim Cook was not doing that.
wouldn't should. I mean, some people would say eBay would be a lot more attractive stock if they kept
it. Well, sure,
PayPal, right?
Sure, but PayPal became a $300 billion market cap company at its peak. Netflix, I feel like they were somewhat helpful there. I don't know.
Huge.
Maybe not.
Well,
you think they were?
Actually, maybe they just
I
came
don't
at the right
think so.
time.
Maybe they just got lucky.
He had an amazing
He wasn't
return.
there for very long.
He had a great return.
Yeah, he had a great return,
Yeah.
but I think that was just more like
It was his son. They showed in the
market timing.
documentary. It was really Brett. It was his kid.
Could have been right place.
driving
Could have
that.
been right place, right time.
Yeah. But
Why are tech stocks-
Yahoo was was
Yahoo.
an unmitigated disaster
I
for
forgot about that.
For the activists.
Why are tech stocks tough for activists in general? Because innovation is so important, and that's not their language.
Yeah, it's activism is it's a financial playbook. I think Cheniere Energy. You buy a dump truck company, and if
Stick to
they own
dump trucks, kid.
and they own a media business,
Yeah.
and you can go on and yell at them and say, "Sell the media business."
Right.
I mean, that's
Spit it out.
Raise your dividend.
So obvious shit. That's not.
Yeah, and I think they're not product managers, so they're not getting into the weeds of some tech business and giving advice on what should be done.
To your point, like if you think about some of the really successful, and I mean over decades, not once or twice, some of the really successful activists, like you think about like Nelson Peltz, he operates these businesses when he takes board seats.
Yeah.
And these are companies that are on paper, it's not innovation. It's Wendy's,
Right.
It's Snapple.
It's more private equity,
It's almost like
almost
like a private equity. Right? I was going to say almost like a public equity with a private equity with public shareholders.
Right.
And long term in many cases.
Yeah.
Right.
I think that works, but I think tech, it doesn't work. And then you could say typically the activists are Wall Street guys or gals.
Well, the other thing is some of the best tech companies have these anti-shareholder share class structures where even when you get a company that should be disrupted, Meta, by an activist, then it's not going to happen.
And also
like Zuckerberg's untouchable, almost no matter what goes wrong there.
That's for sure. And I think a lot of if we tried to name what are the tech companies that should be a target for an activist, probably the ones that have been most beat up are crappy businesses. Yeah,
Twitter.
Twitter's a perfect example.
So you got activism there.
What's somebody from New York going to go onto the Twitter board and tell them to do?
Nothing.
The people that will kind of run circles around them. And they'll get to kind of like dawdle along. So I think if Twitter's best hope is probably someone like Musk coming in and doing something there,
and just
because he'll know the BS that the engineers try to feed them and probably cut people and change out people and stuff like that. So
this is a late addition to what we're going to talk about today. We'll do this and then we'll go into favorites and then we'll let you get out of here. This kid Jack Rains, so he writes for Finlit, which is like social media, blogs, Instagram, whatever.
He's in the liquidity mafia.
And I thought this was the best thing I've read this year about online content. And have you seen this yet?
Yeah.
Okay, what'd you think?
I thought it was spot on. I mean, if I wrote, I don't write as much as I used to, but if I go on TV and I make the case for something, invariably I'll hear from, I'll get some kind of mean tweet or something or email like 2 months from now if it ends up being a terrible pick.
You told me to buy this. No, I didn't.
What did you do? Why'd you tell me to do that and all this kind of stuff. So
right. Let me set this up. So this is a kid.
By the way, Jack is like 24, I think.
Yeah,
he's a phenomenal writer.
So this is a kid that figured out something really important about himself and about other investors at a really young age, and it's going to benefit him.
Yeah, I didn't know he was 24.
So basically, like everybody else, he was trading meme stocks and SPACs and all this shit during the pandemic, and it was working. And a lot of people thought they were really smart. And myself, this all happened to this day. If I buy a stock that goes up immediately, it's because of how smart I was. So he built his account up to like $400,000, and he put $150,000 into this thing called Catapult, and wrote about why he was buying it on Seeking Alpha, all above board. Like, full disclosure, I own this, I'm buying it. This is why I bought it. That's what everything on Seeking Alpha should be.
Sure.
I have no problem. I think that's great. And then, of course, it blew up because it's a SPAC and it's interest rates and blah, blah, blah. So this is what he said. When you have a $60,000 salary and you lose $150,000, it doesn't feel great. But that wasn't my biggest concern. My chief concern was that the article I wrote about Catapult had been viewed by tens of thousands of people, and I told dozens of friends and acquaintances about the stock. I knew there was a pretty good chance that at least a few of them had invested money because of me, which means that they lost because of me. One silver lining is that I lost more on this trade than anyone else. I certainly suffered the consequences of my conviction, but the fact remained that other people still lost money on my recommendation. This was a defining moment in my writing career as I came to two realizations. One, I'm not a market genius. I'm just a guy who played a hot trend well for a while. Two, I'm a convincing writer who could explain my arguments well. That second point really hit home for me. As somebody who can be very persuasive when I write, there's like a responsibility that comes along with that. Mm-hmm. And I don't even think most people in their 50s and 60s who are writing about market stocks feel that responsibility to the extent that this kid does. So I know you've been somebody that's been writing about stocks for a long time, and you've done Seeking Alpha, you've done blogging, everything that I've done also. How do you feel about like what he's saying here, and is part of this responsibility ultimately on the reader who takes action based on something they read?
Yeah, I mean, first, it's tremendously insightful. I wish I had been that.
It's a great piece
at 24.
Yeah.
I think about it. I definitely think about it a lot because part of what you do when you write about something is you're making your case. If you're a debater in high school, you want to do the best job at making your points on the debate team. Or something
Here's
like that.
why I'm convinced on this stock.
I'm going to make the case for it, right?
Yeah.
And so you want to put that out there, but then if there are unintended consequences of that if it's too convincing or something like that. So should people learn for themselves? Well, yeah, of course. I mean that's part of growing up. And
so he's like, I'm done writing about individual stocks now.
Yeah. Oh, is that what it said? Well, I would say this.
I wouldn't do that. I wouldn't go that far. I think you should come back.
There's a huge difference between being intellectually open and honest and giving your opinion and possibly being wrong versus doing what Micah Saylor did, which is saying take out margin on Bitcoin, sell your house, buy Bitcoin. Those are two very different universes. Right?
Yeah.
So you do the best you can, and you're going to be right, you can be wrong.
And to be honest, like one of the things I like Cathie Wood for, and I think I do a bit of this myself, and one of the things I dislike about most of the folks that I see going on business TV and talking is that most people, they never want to stick their necks out. They never want to make a bold prediction. They never want to, if it's a sell side analyst for career preservation, I really like this stock, but I think it's going to go up 10% between now and 18 months from now.
But Eric,
something like that.
his job is not sticking his neck. He's not getting paid to stick his neck out. He's getting paid to be there.
Yes.
Yeah.
But I appreciate people that are willing to,
give an opinion.
Yeah. Put it on the table.
Okay. And that's why me and you like each other for sure. So neither one of us are afraid to do that. For better or for worse.
Yeah, for better or worse.
Me either. There's a 50-50 chance.
Jack's blog is youngmoney.co. Young, talented, up-and-coming writer. I hope he goes back to writing about stocks. And I think there's a way to do that right. Like, there's a way to say, look, by the way, our friend Packy McCormick starts his newsletter off with, I'm an idiot, don't listen to me. Now, here's what I'm going to tell you. And I like that approach. I like this idea of like, by the way, don't even read another paragraph if you're incapable of saying to yourself, oh, maybe I should do some research by myself rather than just blindly act. The other thing is people writing about stocks are not saying you should do this too.
Right.
Now, in his case, he was, right?
The reality is people don't want to do the work. They want other people.
They want to outsource, their brain power to somebody else.
Yeah. That's what it is.
Anyway, go read that, and congrats to young Jack for having that realization. Okay, we're going to do favorites. Eric, you're going to go first. What's something that everybody should watch, listen to, read in your world?
Ira Stone conference on YouTube. One guy that didn't wear a T-shirt on his bed to do that was Stan Druckenmiller. Stan.
He should have, though. He should have.
That would have been great. Stan was interviewed by the other co-founder of Stripe, John Collison.
Okay.
And it's about an hour, and it's just extremely interesting. I really respect Stan as an investor because he's made a lot from growth investing, and I think he had a line where I probably made 90% of my money on growth investing. But he understands macro, he understands
himself,
bonds, he understands himself. He's he knows his own biases
and talks about it all the time.
Yeah, and it's just tremendously eye-opening if you haven't heard it already.
He's one of the guys, right? Maybe trading Mount Rushmore.
Yeah.
He's one of those guys in terms of influence, what he's done, what he's built.
He's definitely Mount Rushmore.
I can't think of anyone I admire more as an investor.
The thing is, do you have space for both him and Soros? You probably don't, so you have to pick one of those two. That's a whole other. We could do an hour on this.
I appreciate, as somebody who says I'm a tech investor, I just find it tremendously impressive that he has this broader perspective and he's able to kind of move from these different domains.
Okay, so search YouTube for Stan Druckenmiller at the new Irish. He's been at Sohn a bunch, so the new
2022.
One. Okay. All right, Michael, what do you got for favorites this week? Hit us.
The season finale of Barry was. Do all of you guys watch that?
I'm not up to it yet, but
I haven't seen it yet.
Are you watching it?
I'm watching it. I'm not up to the season finale.
So,
no spoilers.
Duncan,
John, you watch?
I
haven't seen this finale.
Is Bill
Same. I haven't seen the finale.
Is Bill Hader like incredible or what?
Yeah, he's amazing.
This show is it's so unique. There's nothing else like it. It started as pretty much a straight dark comedy, and now it's just dark.
You've been telling me for 3 years to watch it. I started watching it. You're dead right. I really love it.
How great is NoHo Hank?
One of the best characters on TV.
Mr. Kusino, where are you? Where are you?
Winkler's still on the show. I'm in season 2.
He's a prominent. It's so good.
Yeah.
We have people in the comments thinking that you're playing NoHo Hank.
Oh my God. Oh, that's really funny. Halloween idea coming up. Halloween show. I want to give you guys a podcast episode, and let me just give you props for Hustle.
Wasn't that great?
Great movie. So Adam Sandler.
Did Justin love it?
The best thing he's ever done for Netflix.
Did Justin love it?
Not a high bar. Justin loved it. No, Sandler goes like back and forth. He's like, all right, this time I feel like being goofy. Where's Chris Rock?
Yeah.
Right. And then every once in a while he'll do something where he's like seriously acting, and it's still Adam Sandler. Like, he can't really be an actor and not be Adam Sandler, but this is one of those serious ones. Mm-hmm. But I've never seen so many NBA stars, present and former, in one anything. It was so cool.
Yeah.
How good was Anthony Edwards as a villain?
Everybody was great.
Trey, I mean,
Anthony Edwards, if he
was
like
good.
hurts his ankle and can't play anymore, he could legitimately act. Yeah. God forbid.
I really enjoyed that movie.
Did you see it?
I haven't seen it. My kids have told me to
watch it on the plane home.
And I've heard it. If you're an NBA fan, it's
my son is an NBA nut, and I showed it to him. He's like, "No, I don't want to watch this. I'm not in the mood." He's like, "There's no finals on this night, right?" So he watches it, and then the next morning he's like, "Dad, I watched it 3 times already." So he never ended up going to bed. Loved it. So great call, Michael. Cardiff Garcia's podcast is fucking great. So he is not doing what did the Fed do this week? Like, he's an economy guy. Used to be at NPR. He was at Financial Times. Yeah, you know Cardiff, right?
Yeah. He's got a long.
Have you heard of a podcast yet?
No.
Okay.
I didn't know he had one.
He's great. He's because he's very understated. He's not a promoter like I am. More people should be listening to it. He's really going out of his way to try to find guests who are off the beaten path and have knowledge on something that most people don't have. So he's got an episode from 2 weeks ago about immigration myths, and he brings on somebody who, an academic, she used a database from Ancestry.com to bust every myth that you hear people spout about immigrants to America and what happens, and why is this generation of immigrants not assimilating as fast as the Ellis Island generation, or why don't they name their kids American names, or why aren't the second generation becoming wealthy at the same way? And most of those suppositions turn out to be false when you look at the data. So I thought that was a really great episode. And if you've never heard Cardiff's show, it's called The New Bazaar. And that episode is a really great introduction to what he does. So shout out Cardiff, and we'll definitely have Cardiff back on the show, right?
Yeah.
We're overdue.
Yes.
All right. It's been an amazing episode. Did you have fun?
It was great, guys.
Do you want to try to do this one more time just to make sure we get everything right, or you feel good about this version?
Yeah.
He's good?
No, we can take it from the top.
One more time?
Yeah.
All right. Eric Jackson, ladies and gentlemen. And where can we follow you? Where can we find your stuff? Tell everybody where to go.
Twitter. Eric Jackson on Twitter.
You at Eric Jackson?
Yeah.
Okay, what else? TikTok. What is it? No, not yet.
EMJcapital.ltd.
Okay. Are you writing anything publicly or no?
Not. I've got a newsletter on Twitter you can sign up for, but haven't been doing as much.
Another 10% down in the NASDAQ. You can start writing some shit. I got a feeling. I was kidding. Eric, you're the man. Thank you so much for hanging out with us. It's a pleasure to see you as always. Hope to see you again soon.